In this video, I'm using a simple example to show you the meaning of deferred tax assets and deferred tax liabilities. And I use very simple numbers, and this part I highlight is tax reporting. This is a financial reporting or GAAP reporting. Okay, let's first take a look at this case. I assume the tax revenue is same as financial revenue. The only difference is the tax deduction is less than financial expense. The difference is 30. So this will result in the taxable income 50, financial income before tax is 20. So taxable income is greater than income before tax. If I assume the tax rate is 30% for both reporting, so the tax owed is 15, while the tax expense is only 6. So that means the company should pay $15 cash to IRS, the government. And in their financial reporting, income statement only recognize 6 as tax expense. Why tax owed is greater than tax expense? Obviously, because the taxable income is greater than income before tax. Actually, the revenues are the same. The only difference is the deduction and the expense. So actually, the reason is the deduction is less than the expense. So the $9 difference, how we record the $9 difference or show this $9 difference in the financial reporting. And we know the company has to pay $15 cash to the IRS, so the assets will decrease 15. And also recognize $6 expense. $6 will have negative effect on equity, so it's negative 6. Actually, we recognize $9 as deferred tax assets. Okay, so this is like a $9 prepayment to the government. So it is considered as assets. Another example is basically similar. I assume the expense is same as the deduction. The only difference is tax revenue and financial revenue. Because expense equals deductions, tax revenue is greater than the financial revenue. The difference is $50. This will result in the taxable income is greater than the income before tax. Finally, tax owed is greater than tax expense. This also will result in the deferred tax assets because the company paid $30 cash but only recognize 15 as expense. So the difference is $15 prepayment to the IRS, which is recognized as assets. So this is the two circumstances the company recognizes deferred tax assets. They are same because in both circumstances, taxable income is always greater than income before tax. And if we look further, we find one is the deduction is less than the expense. The other is revenue is greater, the tax revenue is greater than the financial revenue. So I can summarize here. So when tax owed is greater than tax expense or the taxable income is greater than income before tax, the company will recognize deferred tax assets. And there's two reasons why taxable income is greater than income before tax. So if we assume the expense equals deductions, tax revenue is greater than financial revenue. If tax revenue equals to financial revenue, the tax deduction is less than financial expenses, as shown in the example here. Next, let me discuss deferred tax liabilities. Similar examples. Okay, actually I only flip the example. Here I assume deductions is 50 for tax reporting, 50 for financial reporting. The only difference now, the financial revenue is greater than the tax revenue. This will result in the income before tax is greater than taxable income. So the tax expense is also greater than tax owed. If we enter this information into the balance sheet, $30 expense, $15 assets. Right, so the difference is actually the liability increase 15 to keep this accounting equation balanced. The reason is the company recognizes liability because the company incurs 30 but pay 15. In other words, the company owes the government $15, which is going to be paid in the future. That's liability. The other case is when the revenues are same, tax revenue equals the financial revenue. The only difference is the deduction is greater than the expense. That will result in the income before tax is greater than taxable income. Again, tax expense is greater than tax owed. This again will also result in the deferred tax liabilities. Same as the deferred tax asset example, we can summarize. When tax owed is less than tax expense, or taxable income is less than income before tax, the company should recognize deferred tax liabilities. And there's two reasons result in taxable income is less than income before tax. One is if we assume deduction is same as revenue, deduction is same as expense, the tax revenue is less than financial revenue. If we assume revenues are same, so tax deductions is greater than financial expense. Also, I use the numbers shown in this example. Okay, so every year, because the timing difference between tax reporting and financial reporting, the company will recognize both deferred tax assets and liabilities for different revenue and expense items. So there's always different revenue items in tax reporting, which is different from the revenue items in financial reporting. Also, the deduction items is different from the expense items in the financial reporting. Okay, remember, deferred tax assets and deferred tax liabilities are both permanent account in the balance sheet. So that means it can be accumulated. That's why when you take a look at the tax report, tax disclosure in the financial reports, you can find an exhibit or a schedule to show the balance of deferred tax assets and deferred tax liabilities for different resources. Let me show how this works. Okay, so I just assume in the year 1, the company recognized $9 deferred assets. Okay, the reason is the expense is greater than deduction, or the taxable income is greater than income before tax. Okay. In the second year, this happens again. The company will recognize $9 deferred tax assets. So now let's take a look at the T account of deferred tax assets. In the first year, we debit 9. In the second year, we keep debiting another 9. So the balance at the end of year 2 for deferred tax assets is 18. So if this trend keeps, so deferred assets will keep increasing. But we know finally it will be reversed. Right? Just assume in year 3 it reverses. In this case, the deduction is greater than the expense. So taxable income now is less than income before tax. So the effect is the company is going to pay less tax than what it incurs. This will consume the balance of deferred assets. So we're going to credit, which should be here, right on the right hand side. So the balance now is 9. So actually, when we read the 10K form, every company will disclose the balance of deferred tax assets and deferred tax liabilities. And also you will observe the different the resources of deferred assets and deferred liabilities. It will give, this disclosure will give us more information to understand the business, especially the company's future performance and accounting quality. I'm going to use an example later.